Welcome to the Forged in Fire podcast. Meet your host, Nate Farmer Eden, co-founder and CEO of Eden Capital, dedicated to achieving financial independence for his community, and Cole Farrell, founder and CEO of Vulcan Capital, a real estate expert with a passion for empowering others through education. Stay tuned for another episode right here on Forged in Fire.
Welcome back, everybody, to another exciting episode of Forged in Fire. I am your co-host, Nate Farmer Eden. I'm going to introduce Cole. Cole, how you doing, brother? Come on stage.
Hey, what's going on, man? How are you?
Dude, we're fired up, man. We got a lot of good things happening. I'm super excited. I'm currently knocking out a few more recordings for this awesome launch that we've got coming up, man. But what about you?
Dude, same thing. Things are finally settling down a little bit after closing. So we're kind of gearing up for another closing, which we're not going to tell you anything about until after it's done. And then I think we're taking a little chill for the holidays, which will be nice. But things are moving. We have a cool event coming up, and I know you're super excited for it, right?
You know it.
Awesome. So anybody that's interested in learning real estate, whether it be to invest themselves, invest somewhere else, however it may be, if you just want to go into real estate because you're excited about the idea or you're just not sure what exactly that means, but it's intriguing, come join us. We're hosting an event. You can go to forgereiacademy.com/webinar, and it's free. You'll join the webinar. We're going to talk shop about real estate and all these kind of fun things, and we'd love to have you. But anyways, let's go through some housekeeping things, right? First, as always, please leave us a rating and review. We want to keep growing, educating others, and that would help us do that. Secondly, please subscribe so you don't miss an episode. And lastly, please buckle up. As always, it's going to be a hell of a ride.
Dude, it's going to be so good. Today, we are going to be interviewing Jim Pfeifer. This is amazing. I heard a little bit about his backstory, but it's going to sound way better coming from him. He is a full-time passive investor, founder and former president of Left Field Investments, and co-host of PassivePockets. Jim, come on stage. How we doing, brother?
I'm doing great. How are you guys doing?
Doing good, thank you.
So I'm curious, Jim. Tell us a little bit about you, kind of what got you here, what brought you here.
Well, that's kind of a long story, so I'll try to shorten it up a little bit. This is kind of like career number 6 for me, and I've always been in finance, and started out, my first job just working for a reinsurance company, so just doing finance and marketing, and then I was a finance teacher for a while, and at that time, it was 2000. Well, I guess 6, 7, 8, our family was growing. And so we bought a house, built a house, couldn't sell our old house, became an accidental landlord. And at this time I was so confident that, stock market, paper assets, mutual funds, that was the way to build wealth. And then I had to rent this house that we couldn't sell. And I was a landlord and I hated it. But a finance guy started seeing the numbers. And I started thinking, wow, this real estate stuff, these tax benefits, wait a second, they're paying me all this. This is kind of cool. And so I slowly thought, okay, I want more of this. And that house that we had was completely paid off. So I got a loan, financed it, and bought 3 more rentals. And then I was off to the races. So then my career kind of developed, and I stopped teaching and I became a financial advisor. And, when you become a financial advisor, they kind of break it down and they act like you don't know anything about money, and they start from the beginning. And so as they were teaching me, about money, and they were showing me all these paper assets that would accomplish the goals that they're talking about, I was over here with a growing real estate portfolio and thinking, you guys are right about everything except for where to put the money, right? You're teaching me about money, but you're putting it all in the wrong place. Put it in real assets, not paper assets. And so, I did the financial advising for a while, but the problem with that was I was doing mostly real estate, and I prided myself in putting my clients in the same investments I would be in. And I wasn't doing the paper stuff anymore. So that wasn't working out for me. So I became a full-time active investor. And at that time, I started a little community in Columbus, Ohio, where I live. And it was fantastic. We had a meetup with, 50, 60 people a month, and developed a lot of relationships. That's kind of where I found the sense of community and how that can help you in business. So then finally, now we're getting to the meat of it, right? Then I found out that I wasn't really good as a real estate investor. I wasn't a good asset manager. I thought I was passive investing, right? And that to me meant buy a property, hire a property manager, and then fight with the property manager all the time to see if you can make any money. And it was a disaster, right? I was lucky. None of them cash flowed, but all of them went way, way up in value because the market was just unstoppable, especially in the markets I was in. I just made money, dumb luck, right? That's not really the way to do it, but that's how I did it. And then I found this thing called real estate syndications, where you can invest passively. And you basically essentially hire an asset manager to manage the properties for you. And all you have to do, it's a big all, but you have to vet the operator, find the deal, and then just go along with them, right? And so when I did that, I realized, okay, this is what I want to do. But I need help, right? These are long-term illiquid investments that are completely out of your control. So I want to know what other people are doing. Are other people doing the same thing as me? So I started a mastermind, which was going to be 12 people in Columbus, Ohio. We're going to have dinner once a month and talk about being passive investors in real estate syndications. And our first meeting was March 18th, 2020. And I hate to turn the clocks back, but if you remember, that's when the pandemic shut everything down. So we didn't have dinner. We did not meet, but we went on this new technology you guys might have heard of called Zoom. And we started having Zoom meetings once a month. And I purposely limited it 12 people, then 20, then 30. And the cool thing was we were able to get some very high profile speakers to come talk to our little Zoom meeting of 30 people because no one could do anything else, right? So we had some really great guests and the community grew. And, we spent the first year trying to limit it to no more than 50 people because I was thinking mastermind. But in truth, there are so many people that are thirsty for this kind of knowledge. How do you invest in real estate syndications? How do you become a limited partner investor? That it just blew up. And we kept getting new members. So we came up with a name, Left Field Investors, because we're way out there in left field. That's what my financial advising colleagues used to tell me when I talked about real estate. You're way out there in left field. So we called it Left Field Investors. We started a podcast. We got a website. And it just went from there. And we grew it to about 2,500 members. And in the fall of 2024, we partnered with Bigger Pockets to transfer the community to PassivePockets. And that's what we are now. We're PassivePockets. And it's basically just a community that helps LP investors learn how to grow their wealth, become independently wealthy, hopefully financially independent, whatever that means to you, through real estate syndications. So that's my story in 5 minutes, I guess.
Holy cow. First and foremost, I appreciate you taking us on this journey. I mean, especially hearing, about how you kind of tripped and stumbled into, or dumb luck, as you called it, winning on real estate after placing your money in, fighting with the asset managers and the property managers, and then just appreciation over time was like, you know what, we're going to be on your side. We're still going to help you out. You're going to be good. And then you're able to be able to take that and then learn about syndication. So question for you, so many different avenues to go down, but you had mentioned once you started getting into syndication that one of the key pieces was getting to know and vet some of the operators. So can you talk about some of the hurdles, some of the struggles, some of the challenges that you had to face when it came to just entering into the syndication space and how you got to know, like, and trust operators and what that looks like today?
Great question, because that was a journey, man. So the first thing I did before I even started Left Field Investors, when I was just kind of dabbling in syndications, I did so I worked in business for a long time. When you go on a business trip, the company pays for everything and it's really easy. So now I wasn't working for a business, but I wanted to go to a real estate meetup, a conference. But I was really nervous because I got to pay for my own travel, my own hotel. It doesn't sound like much now, but it was a huge step for me because I was independent now. So I went to this seminar where there was a bunch of syndicators there, and it was actually how to teach people to become syndicators, a great conference. But they also had a lot of limited partner people there. And I was there for maybe 5 minutes when I figured out, you know what? I do not want to be a syndicator. I do not want to be an asset manager. I want to be this other guy called a limited partner. And so I wanted to find some people to invest with. So I was pretty confident that if you were an operator, a syndicator at a conference, you must be like top of class, right? Why else would you go? You got to be the best of the best. So I had an old 401k that had rolled it over into self-directed IRA. So I had a bunch of cash in my pocket, and I just started walking around to the syndicators that were there and saying, hey, can I invest with you? Here's some money. Here's some money. Here's some money. I see the look on your faces. It was a terrible way to vet operators, but that's how I did it at first. All those deals I got in are okay. One is good. and several are really, really terrible, as you can imagine, because that is the worst way. Because I don't know if you guys know this, but if you're an operator and you want to go to a conference, you just pay money and go. They're not vetting you. So that's how I started. That's not the way to do it. So I learned to do it a different way. So then I started going to Podcast University. I listened to every podcast I could, and most of them were, operators interviewing people. So then I would call up the operator and I would have a 30-minute call with them, and I'd ask them a list of questions and get to know them a little bit. And that was a much better way to do it. So I started investing with people that I liked through that. And that was a really, a more quality way to do it. But the problem there is you can be a podcaster and a terrible operator. You can be a great podcaster and a great operator. They aren't related. So you don't know just by listening to their podcast. The 30-minute call, you get a little bit more flavor, but it's not enough, right? You're asking me, I'm going to talk to you for 30 minutes. Then you're asking me to wire you 50 grand, right? So you got to do something, but that wasn't it for me. And so now what I do is I don't invest with a new operator unless they're introduced to me by somebody I know, like, and trust, who's in my community, who is already invested with that operator, preferably for at least a year. So I still do all the same due diligence. I talk to them. I do some background check stuff. I look into them and I ask them all kinds of questions. But the thing is, I'm starting from a place where I know that somebody else that I have faith in has invested with them and likes what they done, right? So I know that you send the wire, it's going to land. I know that they're going to actually send the reports they say they're going to. I know that they're going to, either send the distributions like they say they're going to, or they're going to give me reasons why it didn't work out. So that, to me, is the number one way to vet an operator, is because if you ask an operator, hey, give me a referral, they're going to give you their best clients. What I'm doing is finding someone who's already invested in them and wants to recommend them to me. And that has changed everything.
I love that on so many different levels. And one of the things that I like that you mentioned is that you can't just expect a deal to close on the first touch. You can't just expect a seller to call you and say, I want to do the deal. You sign the agreement and you walk away. It's so rare, right? These relationships, and that's exactly what they are. The relationships take time to build trust. And like you said, it takes a couple calls. It takes a bunch of different interactions. And that's normal. And I think people that don't think that's the case, I don't want to rub salt in the wound, but I do want to go back because not many people talk about bad deals. And I want to know, if someone's listening to this, bad deals, what specifically about it don't you like? And because I want to highlight the things that are good, but I think there's not enough really sun on the stuff that could go bad. And so I want to hear just the ones that you got into, what don't you like, and what do you think should people avoid, I guess?
Yeah, well, I mean, unfortunately, I've made a lot of mistakes. And one of the biggest ones is I've decided I'm not going to be your guinea pig, right? So one deal that I was in, that I got into at this conference actually, was there's an operator who was doing single family turnkey deals in Dallas, and they were crushing it. But the Dallas market had inflated so much that those weren't penciling out anymore. So naturally, they decided, well, why don't we just do small office buildings in Dallas, right? It's real estate, so they'll be fine. I'm like, yeah, let's do it. Of course, if you were good at single family, why wouldn't you be great at office? Well, I don't know why they wouldn't be great, but they certainly weren't. And I lost money on that. But what I learned was, I'm not going to be your guinea pig. So if you are really good at one asset class and you decide to go into a different asset class, I'm out. Now, if you hire someone who's been doing that other asset class for 30 years and they're going to run that asset class for you, then, okay, I'll listen. I'll watch your first couple of deals and then maybe I'll re-engage. But I'm not going to be where you learn how to do something new. That's just not happening. So that's one lesson I learned. And I'll give you another one real quick. Another lesson I learned is that, when you find, it's hard to find these operators. It's hard to vet these operators, right? That's the hardest thing. So once you find somebody, it's like you found this little golden egg and you just want to cherish it and protect it. And then that operator sends you another deal, and you just keep going all in, right? Because you just found them and they're great. Well, that gets you into trouble too, because you still haven't proven that operator, no matter how well you vetted them. So now there's a person in our PassivePockets community named David Shirky. So I call it the Shirky rule. He does not invest with an operator for the second time until a year has passed. And he doesn't recommend anybody else invest with that operator until a year has passed. So that way, at least you're testing the operator. You get to see, are you sending reports, distributions? Are things going the way that they should? Now, you're not going full cycle, so you're not getting the full picture, but you're getting something. So those are a couple of things, lessons that I've learned through mistakes.
I love that. And one thing I want to point out real quick, just because I get so excited and I think it's important, is kind of what you said. And I have somebody that always told me something similar about like a no start. And they said, I will not invest with anybody unless I know them for 6 months. And that's just this person's rule, not saying you should do that or whatever.
Yeah.
But the point is that I like how you're highlighting these different things that people do to make sure that they protect themselves and to make sure that person is legitimate. And I just like hearing all these different aspects. But no matter who it is or what process they're following, they have some sort of guideline, guardrail, or no start to make sure that person is legitimate.
Yeah, well, it's so difficult because once you send the wire, you're stuck, right? You cannot get out of these. These are, as we said, long-term illiquid investments, right? And there's not very many investments that are like that. Usually, there's some out, right? Here, you might be stuck for 10 years. So another thing I recommend is make sure you actually like the person, or at least you don't dislike the person. There's so many operators out there. If there's somebody who's just like, oh, I hate talking to them, but they have the best deal in the world, I'm going to go to somebody who I enjoy talking to and has the third best deal in the world, right? Because there's so many deals out there. I don't need to force it with somebody. So because you're a business partner for maybe 10 years, right? You want to join a business with someone you can't stand? No, so don't do it.
So good.
So many gems just dropped. I love it. So if you don't mind us diving a little bit deeper.
Yeah.
Now that you're specializing on the LP side of things, what does it look like in terms of markets that you select or how you diversify? I know we kind of talked about you're never going to be somebody's guinea pig ever again, but do you diversify outside of like multifamily? Do you stick with just that if the operator has experience, and let's just call it some other aspect of commercial? What does it look like for you and your team?
Yeah, I got to say that the other than selecting the operator, diversification might be my most important thing. So I think this is a great question. I like to diversify on the top line by operator, so I'm not all in with one company, asset class, same reason, and market. So those are kind of the three general areas. I also, I like to invest at the minimum typically because I don't want, my CPA hates me because I have so many K1s, but the fact that, especially when we went through this downturn, I was in a bunch of different deals. And what I found was concentration in an operator meant that when their strategy failed, that trickles down through all their investments. So if I'm all in with a few operators and something goes bad, I'm in trouble, right? So I diversify there. I also try to diversify by, different debt types. If I was, and I didn't do this, during 2020, 21, and 22, but if I had said, you know what, I'm only getting in a limited number of bridge debt deals and the other ones I'm going to go fixed or agency variable debt, that would have saved me a little bit because I would have had to look hard for something other than bridge debt because everyone was doing bridge debt. So, it changes the diversification, but when everyone's doing something and it's super really successful and can't lose, what I'm trying to learn for the next time is that's when I really need to say, okay, I have enough of that. Let's go somewhere else, because the only thing I know is when something keeps going up, and you're going to come crashing down eventually. So I think diversification is key. And there's a bunch of different ways you can do it. You can also go by, if you're in multifamily, you can do A class, B class, C class, right? Spread it around a little bit by property type. We talked about, different markets, but the Midwest and was out of favor and everything was in the sunshine states. And now the Midwest is coming back. So I was always actively looking for where people aren't, right? I still was all in Phoenix and Dallas and Atlanta and those places. But I also want to always think of, okay, where are people not investing? Because I want to get a little bit, maybe in Oklahoma. I did one in Oregon of all places. So I think diversification is key. And related to that is shiny object syndrome, which I have, right? I want as much boring as I can have in my investments. So I put a little bit of 5% or something where I'm going to go chase something stupid and fun and go for the home run. But 95, 98% of it, diversify into boring stuff that no one's going to want to talk to you about. And then invested a little bit of money in something that could go to the moon. And that's what you could talk about at all your cocktail parties.
It's so good. And it's funny because I think anybody that's an entrepreneur, especially investors, or anybody that's kind of done the active side in any capacity, gets that shiny object syndrome. And it's so difficult for us not to go chase
Oh
that
yeah.
thing. But like you mentioned, it's not the right thing to do. There's a saying, I don't remember the wording at all, but it's the mundane is what makes the money or something like that. And you
Yeah.
just got to get good at it and run with it. And another thing that you said, I just want to highlight is you're following like these tried and true classic almost laws of investing, especially when it comes to like diversification. You want to invest in something that as that's going up, something else is going down. And somebody might say like, wait a minute, doesn't that just kind of balance out? Like what's the gain in that? Yes, but it balances in a good way and everything should be increasing steadily, but it's protecting your downside. So I love that you said you're kind of doing that in the proper ways. It's so interesting.
Yeah, and I'd like to add, you don't have to get home runs if you're in real estate, because the number one thing that erodes your wealth is taxes. And if you're a real estate investor, and if you do it right, you can legally defer, avoid, eliminate most all of your tax. So if you're in the stock market, you need a 15% return to get a 10 or 8, right? In real estate, I could get an 8 and the 8 goes right in my pocket. So I think you don't want to invest in something just for tax benefits, but that's the biggest eroder of wealth. And if you can eliminate, reduce, defer your tax, you're set.
I love that. And it's funny because we talk to new investors all the time, and a lot of them are just so focused on, I need this killer deal. I need this killer deal. And whether it's their first deal ever, or whether it's somebody that's transitioning into kind of larger multi or whatever it is, a lot of people get focused on that home run. And just like you said, we mention and we tell people all the time, base hits. Base hits are what build your company, build your portfolio, and everything else. Obviously, we all want a home run, right? But you can't just bank on that. So I think that's so good. But what I want to ask next is, and you touched on this a couple different ways, but as far as like risk assessment, I guess you kind of hit this with diversification, but is there anything else in just general kind of market, like economy risk, or anything else that you like to really favor? But I guess you kind of mentioned with operators and other things as well.
Yeah, I think you just really need to evaluate it all in the context of your overall portfolio, right? Because I'm mostly all in on real estate, but one of the biggest risk things that I didn't evaluate was liquidity, right? And that was a huge, huge mistake for me. Probably one of the biggest mistakes I made is because I was so excited about real estate. Then I just said, well, okay, I'm active. Now I'm just going to go to passive. Let's go all in. The problem is, at the time I did it, most deals were, 18 months, 3 years going full cycle because everything was rip roaring. Well, when the market changes and that goes from that to 5 years to 7 years to 10 years, all of a sudden it doesn't look so good that I put everything in these investments. Now, if it was my active real estate, I could sell an asset tomorrow, right, that I owned, and maybe I wouldn't get top dollar for it, but I'd get some cash. You can't do that with syndication. So I think one of the things to really manage is liquidity risk, and have an understanding that you cannot go and put 100% of your assets into syndications. You have to have another few buckets, and we call it cash drag, right? You don't have cash drag, but I have, 3 or 4 places where I keep cash for emergencies, for opportunities, and just to protect the liquidity so I can pay the bills and, pay for groceries and things like that. And I think you get so excited about this because this is really a way to just completely change your financial life, is to do this real estate stuff. But you also have to not get so excited that you chase the shiny object or lose your liquidity. And I think those are the biggest risks for me.
Well said. I love it. So this next question you can take in a couple of different directions. When thinking about future outlook, one, you can take it and let us know what you think is going to happen within the market. But two, I would also be interested to hear about your future plans, your future growth. I mean, you went from, with the limited partners, you had less than 12 people that were going to jump on. COVID hit, went to Zoom. That grew into the 50s, into the hundreds. Now PassivePockets is major. So where are you thinking you guys want to transition? What's it going to look like? What are your plans?
So for PassivePockets, we are committed to the same mission that Left Field Investors was committed to, and that is serving the limited partner investor, right? We want people to my passion is I want people to understand. I was a financial advisor, right? Tell me how many people you know that have gotten wealthy investing in the stock market. I can tell you it's none. It's zero, right? The way to build wealth is assets or businesses. Warren Buffett, right? What does he do? He buys companies. Yes, he invests in the stock market, but he doesn't buy a share of FedEx. He buys 10% of it, right? He's buying companies. So that's the way to build wealth is to look at it that way. So at Passive Pockets, our goal is to do it through real estate and show people that, look, you don't have to just invest in the stock market. You can transition your wealth into real estate, do it in a safe way. You're going to lower your taxes. You're going to increase your income, and you'll end up with a lot more money at the end. I'll give you one brief example that kind of illustrates this for me as a former financial advisor. Let's say you retire and you have $1 million, right? And you put it in the market. Every single financial advisor is going to say you could take 4% out a year. That's it, because you don't know when you're going to die. If you can tell me when you're going to die, we can change that number. But since we don't know that, 4%. So that's 40 grand a year. That's the most you're ever going to get, right? You can't take more than that because you don't know when the dips of the market are. So now you got 40 grand, you pay taxes. Let's say you pay 25% and you get 30,000 net. That's the most you'll ever have, because that $1 million is never growing because you're always taken out of it. Okay, let's compare that to the next person who's got $1 million at retirement. They have it all in real estate, syndications or whatever. Well, you could pretty easily get a 7% return, right? Just cash on cash return. So now you're getting 70 grand. You don't have to pay taxes on it if you do it right. So now you have 70 grand and you're not taking anything out of those assets. That's the income from the assets. So now that 70 grand is the least money you'll ever have, because that $1 million is going to continue to grow over time. So which one do you want to be? At Passive Pockets, we're going for the person that wants the 70 grand and then wants that to keep growing. And our mission is to help them figure out how to make that $1 million grow.
Love that. Could not have said that better. And it's funny, it's something you just said makes me think of something Nate and I say on every single one of our opportunities, every single one of our deals. We say we have two objectives. The first objective is to preserve capital, to keep that distribution, but preserve that capital.
Yes.
And then the second objective is to grow that capital. But you can't do that second one unless you protect that first one.
Absolutely.
So I just love that you mentioned that. Such a worthy mission, and it's fantastic. Nate, well, you know what? Before we hit the next section, I have one last question. For your investments, what is the most important thing that you track? Is it overall return? Is it cash on cash? Is it just all in one? What are the things that you like to track?
For me, I want to know how much cash is coming in. So technically it's cash on cash return, but it's basically, I invested 50 grand. How much money did I earn this year on that investment? Because I am a cash flow investor. It's my full-time job. I need the cash coming in. Now, there's some investments that, I do development investments. I do heavy value add that don't have cash coming in. But once that cash comes in, I'm really focused. I'm focused on that. The appreciation is, hey, thank you very much. That's the back end. That's fantastic. But I want to track the cash flow and make sure I know how much cash for each investment I have is coming in every year.
Love it. All right, I think it's time.
Hot seat.
Hot seat it is.
Oh my goodness. Jim, don't get nervous on us now, brother. I think you're ready.
Let's do it.
All right, here we go. Cue the music. What separates top performing entrepreneurs from investors?
I think what I would say is the ability to balance patience and progress, right? Because especially if you're doing something new, you have to push and make sure that you're progressing and doing the things that need to be done. But you also have to be patient. You can't just, if something isn't working, you might need to abandon it. But if you abandon it too soon, you might not have taken it far enough. So you have to have the patience to really evaluate where you are and keep pushing so that you make the progress that you want to make. And they're opposing things, right? So to have patience and progress at the same time is difficult, but you have to keep one in each hand and kind of just balance them, in my opinion.
I love it. What's a daily habit that's contributed to your success?
Just having a routine. I get up every morning and I go for a very long walk. I listen to my podcast. I listen to something entertaining. I listen to something educational. I listen to something real estate, and just doing that every day, it gets me set and ready to go.
Awesome. What is a piece of advice that you would give to yourself if you were starting again?
Well, if I was starting again, I would say get into real estate sooner, but that's too easy, right? So what I would say is look beyond what everybody else is doing. I was so confident that the stock market was the way to go. I got my first stock the day I graduated college because I was really into that kind of thing. And you know what? I never made much money in the stock market. So you got to look beyond what everyone else is doing and look at what the people are doing that are successful. Not what everybody's doing, but what are the successful people doing, and what parts of those things can you replicate and do in your own life? And that's what I would do, is just kind of look beyond.
I love that. I was thinking you were going to say not go to a conference and start finding every operator, but that was a great answer as well. This is good.
That too.
So what is your favorite business or real estate book?
So this is a little bit self-serving because it was written by one of the founders of Left Field Investors. We changed it a little bit, the title. It's called Avoiding Rookie Passive Investing Mistakes. This is a book that Steve Sue wrote, and he's been an investor for over 15 years in syndications, and he wrote 20 mistakes that he made and others have made, and what you can do to avoid them. So you're basically learning from others' mistakes. I think that is one of the best ways to avoid. You don't want to make all the mistakes we made. Read this book. It's a short read, but man, I read it at least a couple times a year because it's powerful book. And it really, if you're going to do this kind of investing, it's a must read. And it's, you can get it, you can get it at PassivePockets.com.
Perfect. We'll make sure to link to that too. That's fantastic. What is your favorite part of owning, operating your investments or business?
For me, it's providing education and a network to people interested in investing in the real estate syndications, right? I'm always been passionate about education, and I want people to understand, as I said earlier, this is something you can do. You just gotta, it takes some time and effort and learning and all that, but anybody can do it. And so providing education and network is absolutely the favorite thing for me.
Love it. What is something new that you've implemented into your business model that's helped grow your success?
Well, I don't know if it's new, but I think just the almost everything I say in these kind of answers at the end are around community. And I think that there's nothing more important than a community for this type of investing. And I've said it before, of course I'm biased. I think Passive Pockets is the best place to be, but if that doesn't fit you, right, the most important thing is to find a community where the culture of that community fits your personality. And if it's not Passive Pockets, then find someplace else, because this kind of investing, you can't do it on your own. It's not like the stock market where there's a lot of education out there and you can just kind of throw money at it. It's not like active real estate where maybe you're good at swinging a hammer or the Indianapolis market. It's very different. So having other people that you can talk to and learn from and share resources with is critical. So I don't know if that answers the question, but community.
So good. You made it through. You survived.
Yeah,
that wasn't too bad, was it?
No, it was fine.
I love it. Well, it was awesome having this conversation and just thinking back on all the stuff. Like, it's so cool to hear your entire story, from starting with that first property, going into financial advising, going into asset management and running your own investments, bridging that into syndications, going to these conferences, learning, podcasting, growing your community. And there's so many things here that I want to still dive into, but we just might have to schedule another episode and go into that, because that's such a different conversation with growing your business and et cetera. So with that said, I have two final questions for you. One, where can people find you? And two, any final advice? Yeah,
you can find me at PassivePockets.com. You can join the community. There's a 7-day free trial, which I think is great, because then you can test it out and see if it's a fit for you before you, spend any money on it. But you can find me there in the forums. My email address is jimpfeifer@biggerpockets.com. I love talking to investors, so feel free to reach out. And the final advice, I think, if you've been listening to me for the last 30 minutes, you're going to know what I'm going to say. It's join a community. It's just, if you want to be a successful syndication investor, join a community. Join several communities, right? I think it's super powerful, and it's the best way to network and meet operators, meet LPs, and just become a quality investor.
Well said. Mic drop. Holy cow. For those that are out there that are listening right now, pause it, hit the rewind, replay this all the way over. Tons of gems that were dropped. This has been an amazing episode. If you're listening right now, make sure you get home safe. Thank you so much for coming through for Forge and Fire. Jim, it was an honor, a pleasure, and a privilege to have you on. I'm looking forward to the very next episode. Thank you. Thank you. Again, everybody, get home safe. We'll see you all in the next episode. Take care.
Thank you.
Thanks.